Welcome to Deep Into Finance family. We appreciate you being here with us. Give us a like and subscribe to our channel. Share with your friends and family, and stay up to date to our future videos. Banks are a vital part of the financial system, playing a crucial role in facilitating the flow of money and credit through the economy. Banks provide a range of financial services, from accepting deposits to providing loans, and they play a key role in the allocation of resources in the economy. In this essay, we will explore how banks work, including their role in the financial system, how they create money, and the risks and regulations they face. Role of banks in the financial system. Banks are financial intermediaries, meaning they act as middlemen between borrowers and lenders. They take in deposits from savers and lend those funds out to borrowers, earning a profit on the spread between the interest rates they pay on deposits and the interest rates they charge on loans. The key function of banks is to provide credit to individuals and businesses, helping to finance their purchases of homes, cars, and other goods and services. Banks also provide a range of other financial services, such as checking and savings accounts, credit cards, and wealth management services, in addition to their role as intermediaries between savers and borrowers. Banks also play a crucial role in the broader financial system. They are key players in the payments system, facilitating the transfer of funds between individuals and businesses. They also provide liquidity to the markets, acting as buyers and sellers of securities and other financial assets. How banks create money. One of the most important functions of banks is their ability to create money. When banks make loans, they create new money in the process. This is because when a bank makes a loan, it credits the borrower's account with new funds, which the borrower can then use to make purchases. These new funds are created out of thin air and are not backed by any tangible asset. The process of money creation by banks is often referred to as fractional reserve banking. This is because banks are required to hold only a fraction of their deposits in reserve, with the rest available for lending. For example, if a bank has $100 in deposits and a reserve requirement of 10%, it must hold $10 in reserve and can lend out the remaining $90. When the bank makes a loan of $90, it credits the borrower's account with this amount, creating new money in the process. The borrower can then spend this money, and it will eventually be deposited in another bank, where the process can repeat itself. This process of money creation by banks has important implications for the economy. It means that the supply of money in the economy is not fixed but can expand or contract depending on the level of lending by banks. When banks are lending freely, the money supply can expand rapidly, fueling economic growth. However, when banks are reluctant to lend, the money supply can contract, leading to a slowdown in economic activity. Risks and regulations faced by banks. Banks operate in a complex and dynamic environment, facing a range of risks and regulations. One of the key risks faced by banks is credit risk, which is the risk that borrowers will default on their loans. Banks must carefully assess the creditworthiness of borrowers and monitor their loans to ensure that they are being repaid on time. Another risk faced by banks is interest rate risk, which is the risk that changes in interest rates will affect their profitability. Banks must carefully manage their interest rate risk by matching the maturities of their assets and liabilities and using hedging strategies to protect against adverse movements in interest rates. Banks also face a range of regulatory requirements designed to ensure their safety and soundness. These regulations include capital requirements, which dictate the amount of capital that banks must hold in order to absorb losses, and liquidity requirements, which ensure that banks have sufficient cash and other liquid assets to meet their obligations. In addition to these prudential regulations, banks also face a range of consumer protection regulations designed to ensure that they treat their customers fairly. These regulations include requirements around disclosure of fees and charges, consumer privacy, and anti-money laundering and anti-terrorist financing regulations. The regulatory environment in which banks operate is complex and constantly evolving, with new regulations being introduced in response to changing market conditions and emerging risks. Banks must carefully monitor and comply with these regulations to ensure that they operate in a safe and sound manner and that they are able to meet the needs of their customers. Banks play a vital role in the financial system, acting as intermediaries between savers and borrowers and facilitating the flow of money and credit through the economy. Banks create money when they make loans, and this has important implications for the economy, as the money supply can expand or contract depending on the level of lending by banks. Banks face a range of risks and regulatory requirements designed to ensure their safety and soundness and to protect consumers. The regulatory environment in which banks operate is complex and constantly evolving, and banks must carefully monitor and comply with these regulations to ensure that they operate in a safe and sound manner. Overall, banks are a crucial part of the financial system, playing a key role in allocating resources and facilitating economic growth. While they face a range of risks and regulatory challenges, banks have demonstrated their resilience and adaptability in the face of changing market conditions and evolving regulatory requirements. As technology continues to advance, the role of banks in the financial system is also evolving. Online banking and mobile banking are becoming increasingly popular, allowing customers to access banking services from anywhere, at any time. Banks are also using advanced analytics and artificial intelligence to better understand their customers and to develop more personalized products and services. However, the rise of fintech companies and other non-bank financial intermediaries is also posing a challenge to traditional banks. These new players are often able to offer faster, more convenient, and more innovative services than traditional banks, and they are rapidly gaining market share in certain areas of the financial system. In response, many traditional banks are partnering with fintech companies or developing their own digital platforms to better compete in this new environment. The challenge for banks will be to balance the need for innovation and agility with the need for safety and soundness, and to adapt to the changing needs and preferences of their customers. Banks are an essential part of the financial system, playing a crucial role in allocating resources and facilitating economic growth. Banks create money when they make loans, and they face a range of risks and regulatory challenges designed to ensure their safety and soundness and to protect consumers. As technology continues to advance, the role of banks in the financial system is evolving, and traditional banks will need to adapt to remain relevant and competitive in the years ahead. In addition, the global nature of banking means that banks are subject to international regulations and agreements, such as the Basel Accords, which set minimum standards for bank capital adequacy and risk management. These agreements are designed to ensure the stability of the global financial system and to prevent systemic risk from spreading across borders. Banks also play a crucial role in supporting government monetary policy by managing the money supply and interest rates. Central banks can influence the economy by adjusting interest rates, and banks help to transmit these changes to the broader economy by adjusting their own lending rates and other financial products. Another important function of banks is to facilitate international trade and commerce. Banks provide services such as trade financing, foreign exchange transactions, and letters of credit, which help to facilitate the movement of goods and services across borders. This is especially important for small and medium-sized enterprises, which may not have the resources or expertise to navigate the complexities of international trade on their own. Banks are also important employers and contributors to local communities. Banks provide jobs and contribute to local economies, and they often support community development initiatives and charitable organizations. Banks are complex organizations that play a crucial role in the financial system and in the broader economy. They create money when they make loans, and they face a range of risks and regulatory challenges designed to ensure their safety and soundness and to protect consumers. As technology continues to evolve, banks must adapt to remain relevant and competitive, while balancing the need for innovation with the need for safety and soundness. Despite these challenges, banks remain an essential part of the financial system and a key driver of economic growth and development.